Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. We put on this show every Friday just to answer your questions and try to help you improve at least the financial aspects of your retirement. You know, whether you're already retired or looking forward to retirement, we're here to answer your questions about things that might help you there. We mainly focus on, how to manage the money, how to, do the retirement planning, and how to really make sure you've got some long-term tax planning in place to help yourself in that retirement time period. So, of course, we answer questions. You can send them in now as we sit. We have an Ask Tom at talkmoneywithtom.com email address. If you'd like to do that now. We also have a chat box here. You can enter your questions in that chat box, and we'd be happy to answer those. And you can send them at any point in time. We do a lot of work with our clients on these strategy sessions and things that come up. We highlight those also during this period of time. So hopefully you find something today amongst these questions that help you. But if you have questions about anything, doing with the market or what have you, please send that in. We'll be happy to try to answer them. Of course, we are huge believers that one of the aspects that really helps somebody in their retirement is education. And so we've created this channel. We have 1,000 videos on here now. And you can subscribe to that channel if you'd like. It's a subscribe button. You can add, the bell button on there too if you want to get notified when we do post something new on here. But feel free to peruse what we have produced so far. There's a wealth of information there that might help you. And then, of course, lastly, we're here to help you on a customized basis. If you want to set up an appointment with us, you go to our website. There's a link to that here on the channel. There's a book appointment button. Looks just like this, actually, up on the corner of the website. We've got our calendars live on there, and you can pick out a 30-minute phone or video time to meet with Ethan and I, and we'll talk to you about your specific situation and maybe answer your questions that way. So however it works for you, we're here to try to help, and hopefully you'll get something great about, your retirement that might help you from today's questions too. So looking forward to helping you with that. Of course, I always like to start off the show with some information and a summary about the market itself for what I saw this week. So this is a chart of the S&P 500 so far for the year. You can see that blue line is the 200-day moving average. Red line kind of is the top trend line that we're watching for right here. And so a couple of things I think are interesting. It's just a little bit of the past history here. So if we go back 3 weeks, okay, this is a chart from 3 weeks ago. We were trying to break through that 200-day moving average, trying to break through that trend line. A really fantastic run. Bottom of the market was June 17th, and that was a huge run up there. And so then, of course, now get to last week. Didn't work. We didn't get through that. We ended up kind of falling back down. And of course, this week it's been really good. Actually, last 3 days especially, market is really kind of moving strongly. You can see we actually had a gap opening today as far as that goes. So very, very good. And so, why are we bouncing here? After all of this run up and then back down, why are we coming up here? And number one is we're hitting some support level. You can see here we spent some time bouncing off of this one way or another. Where we are right now. But really, probably the main thing I think that's driving the market is the same things that drove the market back when we hit the bottom in June and drove us back up to these, nearly breaking this trend. And that was just simply that the sentiment, if you look at the surveys, individual investor surveys, or if you look at the surveys that are coming out from the hedge fund managers, the sentiment as far as what they feel the market's going to be doing in, say, the next 6 months is very, very negative. When it gets very negative, oftentimes you'll have a reversal. You'll have the market go up because the people that are left are the positive ones that think there's going to be some type of an increase here. And then the market sometimes just gets oversold, overstretched to the downside. I use that rubber band analogy. Right, so the market's kind of coming down, the pressure to come back and bounce gets higher the more it stretches. They have a technical measure that I use called the Relative Strength Index, the 14-day Wilder's version, which got down to 31. At 30 or less is considered, oversold. So we had that scenario. We had that same scenario back in June. And then we had this huge short positions out there in the market, just like we did in June also. And so all these hedge funds have reduced their exposure to stocks, and they're using, some of that money to short the market itself. That just leaves the people that think it's going to go up to drive it. And so on Wednesday, we had a 1.8% jump in the S&P 500. According to Bloomberg, the highest short interest stocks went up 4.4%. And so you can see what happens there. The market does bounce, get a little bit of movement, and then all these guys are covering their shorts. When they do that, they're buying back the stock, drives the stock even higher, and that can start a rally. And so that's kind of what's happening here. And pretty soon, people start jumping back in, thinking, okay, we hit a low, we're going to go off, and we're going to really run. And I hope that's true, actually, because I'd love to see this market continue through. We have another big resistance area right above us. And then, of course, the 200-day moving average and that red trend line would be incredible to break through as far as that goes. Historically, we have to remember that since World War II, every time we had a market that was down more than 20%, when it recovered more than half of that, which we did in this run-up from the bottom of June, we never got back down to a new low. Not ever since World War II. So that's great. Unfortunately, since World War II, we have not had a pandemic. And so this combination of events, sometimes the history of the market can be, a little bit suspect because this is pretty unique. We've got, a situation with a pandemic, high inflation because of the reopening and the lack of supplies, combined with, the situation that happened in Ukraine especially with the energy prices. So, we'll have to play it by ear here. The way I'm looking at this is it's very difficult to tell. Are we going to go back down to new lows? Are we going to go and skyrocket up through that 200-day moving average? We're right on the edge of where we could fall, and so I think the risk is a little bit higher. The leading indicators are down for 5 months in a row, so that's a big deal. The 2-year Treasury is paying more than the 10-year Treasury for a number of months here. That's an inverted yield curve is a big deal. At the same time, we have this situation where things are softening. Inflation is starting to come down, peaked out in July. Looks like with gas prices and all the other things, we might see it drop some more in August. We do have the CPI report coming out for inflation next Tuesday. That's going to be a big deal. It could accelerate this upturn if things are good in that report. It could stop this upturn if they're bad. So again, I'd be very cautious trying to trade in front of that particular report that's coming out next Tuesday. The 21st, the Federal Reserve has their meeting. Be interesting to see what happens and what have you. I will say that if you look at like yesterday, for example, market was up, even though the Federal Reserve was out in force talking negatively, which is what brought this thing down from the high, here recently, and now it's being ignored more because the data that's coming out is showing a fairly strong employment market. First-time unemployment claims dropped. Number of new jobs is has moved up. And you've got several other things that are showing weakness with, price of oil coming down into the low 80s. The housing market starts are falling and those types of things. That's pretty much exactly what we want at this point in time. We want the inflation, drivers to be softening, yet we still want the, market not to end up in a severe recession in order to bring down this inflation. And so that's where the jobs could be the portion that they can push on and still keep us in what they call a soft landing or the Goldilocks zone. The data is showing at the moment that we're heading into this Goldilocks zone. We'll have to see how that plays out. The real fear here, outside of the potential contagion events that can happen, China's situation and what's going on in Ukraine and those types of things, the fear here in the U.S. is that the Federal Reserve over-raises rates. And essentially, if you listen to them right now, what they're telling me is we're going to over-raise rates if we have to kill inflation, even if it means killing everything else in sight. Now, they might not do that. I think they'll probably chicken out on that in the end. But you do have to take what they're saying seriously because they're wrong a lot. Just last September, a year ago now, the Federal Reserve said that they, on their little statement of economic positioning, that they did not feel 1 year ago that they would be raising rates in 2022. Well, boy, were they wrong. They've been raising rates like mad in 2022, nearly historic rates, or certainly, since the early 80s. We haven't seen rate increases like this, so they're dead wrong. Now, just last week, we had one of the Fed presidents come out and say that we're not even going to have a rate decrease in 2023. Okay, the market is expecting a rate decrease in 2023 because we're going to raise rates. It's going to slow things down so much that they're going to have to start to lower rates or at least stop raising rates in 2023. Again, the market was basically last September, if you look, said that the Federal Reserve was going to be raising rates about 2.5%. That's pretty accurate. We've been exactly in that range. So the market's been more accurate here in terms of the expectations. But that has caused the Federal Reserve to get even more aggressive in their rhetoric because they really, really do not want the stock market to go up. Because it makes their job harder as far as that goes. So that's going to be the battle. It's why we have right now 18% of our stock market exposure in T-bills and ultra short-term bonds. With the conflicts of good things that are happening in the data and the bad things that are happening with the Federal Reserve's rhetoric and all these different pieces that are out there. I think this is a point in time to be a little bit cautious. I mean, so if we have a 100% portfolio, we're still 82% in the stock market. If we have a 60% portfolio, we're about 48, 49% in the stock market. Still lots of exposure. And what will happen is if the market falls farther, we'll reduce our exposure more. If the market comes back up, we'll reduce our exposure to these conservative areas and get back into our normal stock market exposure, especially if we can get back in and break through this 200-day moving average. You can see how important that average is to the market. It got within 1 point of the 200-day moving average. And if you look at the minute-by-minute chart, it fell really hard right away as soon as it got there. So there's a lot of basically selling going on. If we can break through that, I think that could turn into buying, actually. Because historically, when you break through the 200-day moving average in these big downturns, that has been a sign of good things to come. Not always, but most of the time. So that's what I'd be looking for. So this is a time to be patient. Wait to see what happens. See what happens with the CPI number on Tuesday. See what happens with the Federal Reserve's. Are they going to raise 0.75%, 0.5%? What are they going to do? The market is basically factoring in a 0.75% increase right now. So if that happens, I don't think we'll see a lot of things going on. So it's more what are they going to say, and then maybe there's a surprise. Maybe the CPI number on Tuesday is better than expected. Those type of things. So that's what's happening right now. Just a time to be a little bit cautious. We have our little parachute. We're ready to go if things do get worse, and we're going to react to whatever happens going one way or another. I'm very happy to see the market doing well here the last 3 days. Lots of energy there, lots of motion. So hopefully that continues. Again, a lot of it might be short covering, but nonetheless, when you have short covering enough, you can often get a really big run up, and maybe that'll be enough to get us back through the 200-day moving average. So let's watch and see what happens here. Things will finally get to where they need to go eventually. We'll figure out what to do as far as that goes. But so just a little bit of patience here, which is exactly what I called for in January. I called for patience about the market this year because this is going to be a tough environment where they're raising rates this much. So anyway, that's what's going on this week. Look forward to talking to you about what's happening next week. Thank you. All right, Eason, I know we have some questions that came in already that we were talking about that look really great. Again, feel free to send in any questions, and we'll get to those as far as that goes. But let's start with the first question.
Sure. Our first question is, in previous downturns, bonds and TIPS, Treasury inflation-protected securities, have been used as parachutes, but this year bonds have performed terribly just year to date. Why is that? And should I have a different parachute for this downturn?
Yeah, if we look back, these are kind of these rolling downturns. So 2000, 2008, and now 2022. Okay, those are the big ones that we're looking at where they're, we had 2018, it dropped kind of a V and, came right back. 2020 dropped. Those are a little bit different. So in these rolling downturns in 2000, bonds went up. They did really well. Great parachute. As far as that goes. 2008, they actually originally fell because the problem was covering these insurance policies sitting on top of these mortgage bonds. People were selling everything to do that. But once rates started to decrease in that environment, bonds came back up and became an okay parachute in 2008. This one's different. because of the raising of interest rates at such an aggressive, pace, you end up with a situation where the bond market is going to fall in that environment because that's how it works. Bonds readjust their rate of payment by falling in value. So if a bond used to pay 2 and now it should be paying 4, the value will fall, so now it's paying 4, right? I mean, that's kind of how it works in the simple terms. And obviously, it's a very difficult environment for stocks, just because, again, first of all, bonds are now paying more, so you can take less risk and buy a bond, and so that takes money away. And then secondly, it makes it more difficult in this higher inflationary environment for companies to have consistent earnings, because you're pressing on all of their expenses on the upside, and maybe they can only raise their prices so much before they start having a compression of their earnings, right? So that's what's happening here. I do have something to show you for this question. It's kind of interesting, and you can see, where some of the potential parachutes are. Now, a parachute is designed to slow your descent, right? So anything that makes more money or loses less money than the stock market is a parachute, right? So even though the bond market's terrible, and it really is, it's historic, it's still better than the stock market in general. So this is the Vanguard Total Stock Market Index ETF. It's essentially the entire U.S. market. I believe it's about 98% of the stocks that are out there. It's over 4,000 stocks. It was down, looks like 16.1% so far this year.
Yep.
Okay, got down lower than that at that bottom point in June, but that's where it is now. And so let's look at some of the other things that would be traditional parachutes and how did they do. So the first thing you look at here is the Vanguard Total Bond Market Index. All right, that chart looks pretty bad.
Yep.
But it's down 11.5%. Okay, so not good. I mean, it didn't go up like it did in 2000. It didn't eventually go up like it did in 2008. And it is down quite a bit, and so that's kind of a problem. But still, it's a parachute. If you had 100% VTI versus, say, half and half, you're better off with half of this. This is BND, right? The ticker symbol, Vanguard Total Bond Market Index ETF. But it's not a great parachute, but it's still somewhat of a parachute, just falling less. So then there's some other, traditional standpoints. This is gold. So gold's kind of designed, theoretically, on an investment standpoint. We've all heard this over and over again. This is the environment. We got high inflation. We got the situation. And you can see it ran up, actually. This is all year to date. It had a big run up, but it's now down 7%.
Yep.
Better parachute than bonds, but the volatility is a lot higher, right? I mean, it was up a lot more and, it's come down. And so, but gold is an okay parachute in this environment. We don't use it because for the long term, it's just such a volatile asset. And we try to stay away from some of those in the construction of our portfolios. We're trying to find some more consistency, but gold would be a parachute that did okay. And then this is the short-term Treasury inflation protection security. So what happens here is, first of all, short-term just means, in this case, 0 to 5 years. This is the iShares 0 to 5 years TIP bond ETF. STIP is the ticker symbol. You can see it's all over the place. Looks like an EKG machine, but it's only down 1.8%.
Yeah, but if you actually looked at this as just a price thing, it would be down 6%. So the yield has come up kind of to adjust for that. And so we're looking at the total return. So if you're just looking at this as purely as a hold and your price has gone down, you've lost 6% on it.
Yeah, but that's the thing that these are supposed to do. A little bit like gold. They're meant for this time frame because they do adjust their yield as they go, as inflation comes up. And so that has helped, right? I mean, it's down less when you look at both the dividend and the price, or the interest and the price, but still not as expected. That should probably be above zero, or at least at zero or something, some type of scenario. Again, this has been just such a brutal rate increase so fast that it's created, more problems for that. But again, still a parachute. This is, I think, our top 3 or top 5 holding is in this, so it's nothing to be super proud about, but it's better than some of the other things that are out there. And we did that, back in, November, October of last year, just because we're expecting inflation to come into play. There's some other things to take a look at. Now, this is one of our key holdings now that we've been placing some of the stock market money in. This is the SPDR, which is State Street's version of the Bloomberg 1 to 3 month T-bill ETF. Ticker symbol there is BIL. And so rate of return has been a grand total of 0.42% so far this year. But compared to negative 16 and negative 12, that's not terrible. And actually, you can see the progress there. It's recently been paying more and more because the 3 month T-bill now is starting to get up to nearly 3%. So that's a nice yield as far as that goes. So that's another parachute spot. We did not use this at the beginning of the year. We're using it now more as just a holding spot to wait and see what's going to happen with the market. But it's not a terrible holding spot as far as that goes. It would be a decent parachute, though, if the market did fall a bunch more, right? So it's good to have that because it's hard. You can't move that money into the overall bond market because that seems to be falling, too, at the same time. So not a bad place. Another place is just money markets. This is the Vanguard Federal Money Market. The ticker symbol is VMFXX. And so this is up a grand total of 0.5%. Same thing, though. This one actually further risk. I mean, it has theoretically a $1 share price that hasn't changed in this whole time frame. Mm-hmm. So there's been no risk so far. That can change. You've got to be careful with money markets a little bit. But generally speaking, they'll stay at that $1. And so then we're starting to see a higher and higher yield. I believe the yield on this is above 2.4% right now if you look at what it's paid over the last 7 days. So, that's reflective of that curve. This is not a bad parachute just because of the low risk,
yep.
Right? So a place to hold money and kind of wait for things to get better as far as that goes. And then there's, utilities, which generally will do well in this environment. This is the Vanguard Utility ETF. VPU is the ticker symbol. That is actually up 8.3%. Utilities tend to be a safe haven because they provide something that everybody needs, and they pay big dividends, which have been really popular right now in this higher inflationary environment. But you can see, it's not a risk-free scenario, nothing like the money market that we just talked about. But that's a hedge. Again, we haven't used that just because, the risk versus reward here, and certainly a problem when the market turns around, these will start to underperform. So, and then the last one has been a hedge this year, especially. This is the Vanguard Energy ETF, VDE is the ticker symbol. That's up 45.6% so far this year. However, if you look at it in the last, I think since the middle of June, has actually underperformed the market a fair amount. So this is quite volatile. I have no trouble with people that want to put something like this in their portfolio, but we tend to stay away from it for the most part just because of the volatility of it as far as that goes. So those are some of the parachutes that are out there. I think it's more important, though, to look at, what parachute you would use, now going forward. And so, again, we're using, money markets, T-bills, ultra short-term bonds, kind of, things that are more, along the lines of this right now, just because, again, if the market takes off, that utility is going to fall. Energy's been falling because of fear of recession. So, there's some really interesting things going on right now in those arenas. So this is not a bad place to be at this point for a parachute, and that's what we're using. We're packing the parachute with T-bills and ultra short-term bonds and things like that. So, but it's a really good question.
So, what kind of possible contagion events do you see in the future, or possible?
All right, so it's a good question. Contagion events just means that something happens somewhere that creates problems for you in the end. In 2008, the contagion was these credit default swaps, they were called. And so Lehman Brothers was failing. There was a lot of problems happening. And the Federal Reserve and the Treasury were meeting with Lehman Brothers. They were looking at a $150 billion bailout. They decided against it. Lehman Brothers had to fold up and close shop, but it created this whole contagion event of the house of cards broke down, and the mortgage, bonds that these credit default swaps are an insurance policy that will pay off if your mortgage bond dropped, and so they had to pay off, and so they had to sell everything. So that's what contagion's about. I mean, so they're selling your stocks. Your money becomes somebody's source of funds. That's the issue. So the thing about contagions, the real ones that matter, that are really, really bad, you don't know what they are. That's the whole point. So the Federal Reserve, I'll never forget, Federal Reserve and the Treasury Secretary being interviewed, talking about Lehman Brothers. They had no idea how big the credit default swap market was, and that by letting Lehman go would just create this cascade. They saved 150 billion by not bailing out Lehman. I think they spent about 7 trillion bailing out the economy. Maybe they would have done it anyway, but that's the problem. It's hard to see those. There's some very obvious ones that we see. Number one is, to me, is China. Mm-hmm. And they're lowering interest rates. Everybody else, including the European Union, is raising interest rates, which is very rare for them. They've had negative interest rates for quite a while. They raised rates 0.75%. And China's lowering rates because of their zero COVID lockdowns and some of the other things that are happening. They've built that kind of empire on a lot of real estate debt, and so it's getting really creaky as far as that goes. If that implodes, it would affect everything. I mean, you could have, in our case, we have basically almost no exposure to Chinese stocks. It won't matter. You know, somebody's going to have exposure. They're going to need to sell the stocks that you own, bonds that you own, in order to do that. The other most obvious one is the situation in Ukraine, specifically having to do with price of oil, price of natural gas, and the price of coal, all of which are coming from Russia into Europe, and we're going to potentially have an energy crisis, especially this winter. So Nord 1, which is a pipeline from Russia, they kept turning it off, turning it back on, reducing the amount. They've now turned it off. And they've said basically until you take away the sanctions, we're just going to leave it off. And so you've got countries like Germany getting half of their natural gas from Russia. And so there, the winter there's going to be more demands. It's going to be very fascinating. See what happens there. But I don't know. I'll go out on a limb here and say that I would bet that even if those happen, they're not the big downturns that people are thinking because they're so obvious. The one thing I'll say here that is a little bit different, but the Federal Reserve, over raising rates is an issue. But more than that, it's just this entire arena that we're in. What happens is when things start to have trouble, the whole raising of rates puts pressure, the stock market falling puts pressure on everything, on companies, on countries, and the bond market falling. All of these things put pressure. And Greenspan had this famous saying, basically when the tide goes out, you can see who's swimming naked. And so what's happening right now is the tide is going out, and that pressure is getting higher and higher and higher. And so it creates the potential for something to happen. And so, maybe it's a third world country or an emerging market that defaults on its debt, right? Because the debt is denominated in U.S. dollars, which has been getting stronger and stronger and stronger, and they're having to take their currency, and basically their payments are going up, right? The cost of their payments because they're having to get dollars. Those types of things. And so that's, I think, overall what I would be focusing on here. And the reason that we have 18% of our stock market exposure, out of the market is because the potential is higher right now. There's just no way around that. There's an inverted yield curve. There's leading indicators are down for 5 months. Those type of things. I think there's some great things happening, and that we could end up with a really good market here. And most of these big market downturns, recoveries, came out of just bad news. March of 2009 was dark. It was the bottom, right? Nobody thought that at the time. So you always got to keep that in mind. It's why we keep some exposure here. But that's kind of what's happening. Obviously, China and Ukraine are the two biggies. But it's more the pressure that's being applied to the system right now. And those companies that are over-leveraged or countries that are over-leveraged or what have you, that's where we could see some problems. So we'll have to see how this plays out. It's going to be very fascinating.
Yeah, and you definitely going to see as the market keeps coming down, or if it keeps coming down, more like Ponzi or scams that are falling apart because they just can't pay out anymore.
Oh yeah, they just had the $196 million one in Florida with the lady. They called her the Mother Teresa of small business because she had this scheme. Her and another gentleman had this scheme where they were gathering money from investors. Over 15,000 investors, by the way, which is a lot more than we have, which is amazing. These scams get so many people involved. It's just incredible. Of course, paying out these elaborate rates of return, because what they claimed was they were lending money to businesses, right? And so they're going to get these huge returns, and they're returning part of that. Of course, in a Ponzi scheme, they don't have any of that. They're just taking your money, paying some of it back to you as payments, and essentially then, taking out the, rest to spend on their lifestyle. Works fine as long as they can get new money coming in. And what we have here in 2008, we had tons of these Ponzi schemes uncovered. And watch, you're going to see a lot more coming up. And so that's probably not a big deal in terms of the overall economy, in terms of the accounts that we have, or the Vanguard Total Stock Market Index isn't probably, but it'll just be interesting. But it's an example of that pressure that comes. Bernie Madoff was discovered in 2008 because the Jets, owner of the Jets, ran into financial difficulties, again, under pressure, and asked for a big chunk of their money back. And he turned himself in because it wasn't there, right? So that's the type of thing, it's a little bit of an extreme example, but that's the type of thing that we have to watch out for here in this environment. It's just, again, things are under pressure. The more they raise rates, the more that pressure grows. And so we just got to see, what comes out of that, if anything. All right.
So what is an annuity?
What is an annuity? In very simple terms, an annuity is a tax-deferred vehicle. So you can take money and put it into an annuity, and it will grow without any taxes until you take it out. That annuity can actually be inside of a retirement account, so you can actually get a write-off when it goes in, but it can also be outside of a retirement account, and you can put in really unlimited amounts of money. You can put $1 million into an annuity, and it will grow without taxes until I take it out. They are offered by insurance companies, and there's two major versions. One is fixed annuity, where they pay a fixed return. It's part of the general account of the insurance company. They can pay a little more than CDs oftentimes, and it grows without taxes until you withdraw. And then there's a variable annuity where you can actually go in and kind of buy different mutual funds and different things along those lines. So that, again, if I go from one fund inside that to another, I don't have to pay tax. I don't have to account for it, a lot like an IRA. So those are interesting. They can have all kinds of different riders and different things on them to give more money to your beneficiaries, lock in the highest level for your beneficiaries, income riders for life. There's a whole bunch of different things that are out there. They can be quite expensive, right? And so that's one of the reasons why I don't think we need to use them as much as we did before, because there's so many other vehicles now that are a lot cheaper that kind of do the same things. And then you get your money out by just, cashing it out or taking some out every month, a systematic withdrawal, or basically you can take money for life, for you and your spouse's life. 10 years certain just means that, get it for your life, or 10 years, whichever is longer, a lot of different ways to get the money out. But that, in a nutshell, that's an annuity.
Yeah, and the thing is with annuities, each one's unique, so it's hard to dive into the weeds with them because they're so complex.
They're all individual contracts. Even within the same, somebody will say, "Oh, I have a Jackson annuity." Okay, they probably have hundreds of different contracts. They're all different, so you have to be aware of that also.
So, what are some industries that have some relative strength compared to the broad market?
So basically relative strength in terms of what's happening in this down market, right, as far as that goes. So we saw a couple in the previous question where, certainly energy has had relative strength. It's up 45% this year, and the Vanguard Total Stock Market Index is down 16. That's relative strength. Not as much lately, but certainly for the year. Utilities. We saw with Vanguard Utility ETF, it was up, 7% when the market's down. So that's pretty good relative strength. That's what's happening that's out there. Technically, the entire bond market has relative strength versus the stock market, just because it hasn't fallen as much. maybe not the entire bond market, but big chunks of it. And certainly the Vanguard Total Bond Market Index has done better, overall, even though it's down a lot, than the overall market has done. So, but I guess a better question that I would think of is just, what is going to have better relative strength going forward? Because energy had it and doesn't seem to have it as much now. Could still do well, especially with the situation in Russia. That could bring up the price of energy still. I hope not, because that's the hardest thing to control, but that's possible. And then, of course, the area that I think, and the area that we've made a big investment in that's still working out so far, is clean energy. We're using the iShares Clean Energy ETF, ticker symbol is ICLN, and it's had some decent relative strength versus the market. And the reason I think that it has some interest to me is that the situation in Ukraine is actually driving kind of investment. I mean, we've already had a large drive into clean energy for a long number of years now, but this is going to bring home the concepts to the entire world that if you are dependent upon another country for your energy, things can go wrong. And so with clean energy and solar and wind, et cetera, you can at least get to a spot where some of the energy is being produced by yourself, and that becomes, a situation where government money is coming in. That's big money, right? You got companies moving in that direction. You got households moving in that direction, and so I like that. I think that's going to do well. It is a fairly volatile asset. So we only have it in our accounts above 50% stock. So kind of that, more conservative accounts, we don't use that just because it does move quite a bit. But that's an area that's been showing relative strength and I think has a chance to continue showing relative strength versus the market. And then, of course, this new Inflation Reduction bill has a big chunk going towards clean energy. Perhaps that helps too, right? We'll see what happens. It's definitely an interesting area.
Especially with iClean, it's a lot of smaller companies that don't have revenue. So, something happens to their revenue expectations, ETF can get really bumped down.
Yeah. Although it's interesting compared to, take cloud computing or, genomics and a lot of these areas. I believe that iClean was down about 40% from its high, and those are down 60 plus. So it's still held up even in that kind of crazy arena of kind of overpriced stocks. Again, I think it has some really great potential going forward and a lot of interest. So but yeah, those are things to be cautious of. It's why we only use it in our more aggressive portfolios. And our biggest exposure is 6%. So, not a lot, but it's still an area that I can think of that I think might have some relative strength coming forward.
So will required minimum distributions be counted as income when determining if the Roth income limits have been reached? So can I still contribute to my Roth even with some earned income, even though I have an RMD?
So a Roth IRA is an IRA that grows tax-free. You can put money into it if you're making money, right?
Yep.
$6,000, and if you're over age, 50?
Yep.
$7,000. You do not get the write-off. So if I put in $6,000 or $7,000 in an IRA, I can write that off of my taxes. I do not get the write-off, but in exchange for that, I get tax-free growth after that, correct? But they have limits to how much you can make. And if you make more than that, then you can't put any money in the Roth IRA. And so if you're over 72, you're having to pull money out of your retirement accounts. And let's say you're still making money and you'd like to add to a Roth. You're going to run into some problems there because potentially that requirement of distribution does count towards your overall modified adjusted gross income. That would drive that number above what's allowed and potentially make it so you can't add to that. Kind of depends. Not a super common scenario because a lot of people have retired prior to 72, but it can happen.
The only other one I could see is if you're doing required minimum distributions for a beneficiary IRA.
Yeah, that's right.
And but usually that would end in 10 years. So And so sometimes you'll have run into issues with that, but it's more of a temporary issue unless you have an older Benny IRA.
Yeah, you could be 60, still working. Now you got this money coming from this beneficiary IRA, and the combination of your work and that bumps you out from being able to add to a Roth IRA. Obviously, once you get into the right tax bracket, you can convert money from your, if you have it, from your IRAs to your Roth, and there's no income limits on that. You just have to do it at a time when you're in a relatively low tax bracket, in my opinion, below the 24% tax bracket. And so oftentimes that means that somebody's no longer working, but not always. Depends on what you're making. So there's some possibility of conversion, but yes, to answer the question, requirement distribution is counted as part of your, number that you have to get under in order to make that contribution to a Roth.
Do you believe we've seen the bottom in June, or this is just another bear market rally waiting for another downturn?
Let me get my crystal ball and polish it up here really good. So this is actually, I think points out, I think, one of the biggest fallacies that happens in investing, which is just simply this concept of, you have to know where things are going to go, and really, over the course of time, especially in short-term moves like we're talking about here, people don't know where the market's going to go, and I don't really know where the market's going to go too. And so, but I do know certain things that I'm looking for. If we break below this support level that we're at right now, right, which we're bouncing off of very nicely, but if we break below that, it's very likely that we're going to skid down into a new low. And so then I would want to get a bit more conservative if we break through this. If, on the other hand, we break above the resistance that's above us and eventually break through the 200-day moving average and then break through this downtrend line that we've had here in this downturn, we could be off and running. Yeah. Mm-hmm. And so we're actually at this kind of precip right now where things could go either way. I could make pretty strong arguments that the market's going to go up from here. I can also make strong arguments the market's going to go down from here. And I'm very, very happy to be sitting with 18% less exposure to the stock market in this environment. Still have plenty of exposure, might reduce that exposure or increase it depending on what happens. But I'd look at it more from a reactionary standpoint. I guess if I tallied up all of the pieces for going higher or lower, you can make a decent argument that it could go lower. But boy, have I ever seen stock markets bounce out of that scenario. You really can't keep a tally. I mean, in 2008 downturn, the bottom was, I think it was March 9th of 2009. I remember March of 2009 very specifically. It was very dark. There wasn't anybody touting, and the market had just fallen about 30% more and it collapsed, and it was ugly, and the market turned around at that point. So that's not uncommon. When you go back to look at the bottoms of these big bear markets, they can happen in a time of darkness. And so that's why you got to be really careful. Again, the market's looking forward, 6 to 18 months. Are things going to be better 6 to 18 months from now? I can make a great argument that they are. Inflation comes down. I mean, one of the things I heard on Bloomberg Radio, I mentioned this last week, but I still think it's kind of fascinating. 1981 is the last big spike in in inflation we had. Huge movements in the Federal Reserve's, trying to kill inflation. The Fed rate came up tremendously. But in 1982, in 10 months in 1982, once they got inflation under control, the S&P 500 went up 106%. Historically, when we hit peak inflation, which we, at least at the moment, the peak was in June. And so July was lower. Maybe August is going to be lower. The markets go up past peak inflation overall, right? So I think it's a little bit questionable of whether we actually hit peak inflation, because we did have some false moves in the 70s where it looked like inflation was coming down, and then it really spiked, right? So that's why the Federal Reserve keeps talking about the 70s. We've got to stay vigilant. We got to keep raising rates. We keep doing these things, and we got to make sure that we drive the market down. The inflation down. That could drive the market down too. So really, I think this is a period in time where you just have to watch and be careful. Stay widely diversified as far as that goes, and have a little bit of a parachute in your, in our case, T-bills and ultra short-term bonds, but because the market could get down from here, but it could go straight up. So I don't know. I don't know where it's going to go. I don't even want to guess. I never do that. There's projections and there's reaction. And I think people that are constantly, I have that all the time. Oh, this is going to happen. I mean, we've had questions on the show. Oh, got to buy gold. Okay, well, actually, it's not that great, right? I mean, they're buying it at the high because it's a high inflationary time period. We've got to buy materials. Not so much. Didn't work very well because it's a projection. This is what's going to happen. I'd rather see some proof. I'd like to see some movement. I want to buy into that movement. I want to buy that momentum. And then, when that momentum stops, I'm going to get out. I don't really care, if it's supposed to do that or not. You buy the price. It's all in the price, right? The information's in the price, and a lot of people lose a lot of money based on trying to do projections. We do a little. I mean, we bought short-term tips because of a projection that I had that inflation was going to come up. Worked out okay. Did better than the overall bond market, but for every one of those you get, there's a lot of them that don't work either. So just reactions to what's going on is more important, and watching for things to break out, looking for that momentum, buying into those things, waiting till the momentum stops and getting out. That's been a strategy that's worked for me.
Do you miss out on anything by jumping into like a trend into like the middle? So like not at the very start of the trend, but a couple, maybe a week or two into the trend or a little bit into the trend. Do you miss out on much of the returns in the long run?
Yeah, you can actually, and that's one of the tricks of the whole thing is because you can't tell a trend has started at the bottom, right? There are some strategies. Sometimes we'll look at like the relative strength index on a 26-day basis. When that gets really stretched and gets below 30, that's what happened in 2008, for example. 2018, there were some periods where you could buy based on that stretch, and you would hit very close to the bottom. So that's one of the things we look for. But in terms of true trend watching, looking at breakouts, you're usually a little bit later in the cycle as far as that goes. So then it's a matter of, how much can it run? So you want to look at that. What's the resistance above that? And say, okay, I'm buying here. How high can it go on a likely basis? And what's my risk for that? So yeah, it's all part of the calculation. But yes, you definitely miss some when you're doing momentum. Hopefully most of your assets are buy and holds. You're already in there. Right? So we're just talking kind of on the margins here as far as that goes. All right. Well, that's another show. Really appreciate everybody coming today. Hope that you can join us again next week. Send in your questions at any point in time. We'd love to, answer those. And of course, you can subscribe to the channel. Go through some of the videos that we have there. Hit the bell button if you want to get notified when we put more. Or book an appointment. We'd love to talk to you. Ethan and I are available on the schedule. And set up a 30-minute phone or video appointment with us, and we'd be happy to talk to you. So thank you very much for coming today, and I look forward to seeing you again next Friday. Thank you.